Alright, people. So the difference between selling a stock within a certain time frame and outside of it will cost a huge percent of your profit margin. But some people won't even realize this. Most people won't realize that selling the same stock at the wrong time will cost them thousands in taxes. And here's how to avoid it. And the reason why I'm bringing up this topic is because obviously we're a couple of weeks away from April 15th, which is tax day, or when we should all have our taxes submitted for taxes filed. Right, that's pretty much what I'm trying to get at. So I filed my taxes not so long ago, and I got the paperwork back, and it was telling me, hey man, this is how much I owe, this is how much I don't owe, this is how much owed from, W2 stocks, all this crap. And so I was like, what the heck? This inspired me to talk about this topic with you guys, and so that's the reason why I'm creating this video. And so everybody talks about the standard deduction or the itemized deduction, but capital gains is overlooked. So because I'm all about holding, investing, and selling when it makes most sense, whether it be individual stocks or otherwise, understand that the timing of your investments can literally change your tax, whether it be decreasing your tax liability or increasing it. And so the topics to cover in this video is short-term versus long-term, how it's defined, who tax what and at what rate. I'm gonna just focus on the federal level because I'm not gonna cover every freaking state law in this video. And mind you, I'm not a tax professional, I'm not a financial advisor, some asshole reading some shit off of a script, but I think it's something that we all can use as a basis, or try to get a certain understanding of where we are in terms of how much we would owe towards the end of the year and how to mitigate that issue. So short-term capital gains tax, it applies for most assets if you hold them in within last year. So it's taxed at an ordinary income rate. So say person A is taxed at 10%, and I say 10% because some people may not earn that much, and so because they don't earn that much or have a lot of tax deferred income, then short-term capital gains is pretty much taxed at 10% of however many realized gains you got from short-term capital gains. Then that'll be your tax line. As an example, if I buy a stock in January and I decide to sell in December within the same year, then I'm kind of screwed. It'll be taxed as part. Long-term capital gains tax, on the other hand, is essentially quite the opposite. If it's been held for more than a year, then you're taxed depending on your income at these rates. 0% if it's under a certain amount, 15 if it's over, I believe the amount is 60, I think 60k or something like that, and then 20% if it's over a certain threshold. As an example, if you buy a stock in January and sell it next February of the following year, then you're taxed. And it's interesting because if I am taxed at 30% or 20%, holding the securities for more than a year will effectively have reduced tax liability by a minimum 5%. So that 5% matters. So why does this matter? And so obviously the immediate benefit of holding a bit longer your securities is because if you sell too early, then you're paying on the same amount of taxes. But at the same time, if you want to take advantage of a certain price strike that you want to experience by selling, then what's that? But at the same time, if you're going to sell, then keep in mind that you are going to be taxed at. On the other hand, if I sell after, then I get to keep more of my. So this especially matters if you own certain securities like ETFs, like BOO or SPY, or even individual stocks with high growth. All of this means is that, as a real life example, say if you have earned 10k in gains, say a part of it is short term and the rest of it is long term. In terms of dollar signs, say if you sell at a short term basis, then your tax liability could be, as an example, at 3k. If you had held that asset for longer than a year, then your long term would be at 5k, effectively giving you a 32k% difference that you could reinvest. Or so as we know, as we all know very well, maybe not, expense ratios, taxes are one of the biggest hidden costs of investing. Expense ratios could be covered in the video, but essentially what it is that price that you pay for own could be anywhere between 0.07, like how I think is currently handled, or even at 0.4% that I've seen in other securities. Anyways, taxes is one of the biggest hidden costs of investing. It's just considering that long-term investment, having that mindset isn't just a philosophy, it's also math-based. So would you rather pay the 15 if you're under 60 or under 80, I forget what's the threshold, or would you rather pay current rate at 60, I believe is at 20%, and so that difference of 5% would be a lot. So even small differences over time. So how does long-term investing or short invest? If you actively trade for short-term profits, you would expect higher taxes. So you must factor this into your ROI. You need to understand how much tax of taxes you will have to endure as a liability for the following tax file. So this is important for people who just not only trade at a daily basis, but trade swings like we've been experiencing recently. This is important. Or this affects anybody who sells either actively or inactively, who just happen to sell before a D. So I've experienced short-term capital gains because I invested and I traded the swing. I saw that a certain company went down by $5. I decided to buy because what the heck. Then it went back up by 7. So okay, cool. I made a I made a $2 difference for each share. Obviously, this is compounded between them. This is obviously compounded with respect to the amount of shares that I purchased. And so if I really wanted to keep, if I really wanted to keep on doing it, then that means my bill for the short-term trading will be a lot higher. But at the same time, you need to understand, like I get it. Lots of people want to experience the money right now. But if you can hold it for a year, then you kind of always want. And so the practical tips, the real world tips that I want to share with you guys is to also consider tax loss harvesting. All of this means that if you sell certain securities that you've been meaning to sell for a while, like certain stocks that have been performing bad, and you just want to get rid of them. So if you had sold and gained $500 in gains, and you sell another security for a $100 loss, and so the difference will be 400. That 400 would be your basis for your tax. So in some, accidents aren't an enemy; they're just part of the game. So if you plan smart, you'll keep most of your gains, and that compounds work. Another way to think about it is the difference between short-term, long-term gains can literally decide how fast it grows. Now you know, not just about something you use it. So understand the rules of the game. We all are playing the same game. Just got rules of it to be successful secured. And so understand that the point of this video is to be informative and not direct and not instruct for those who are listening to understand that capital gains, taxes, and investing is all part of the same bubble for those who want to compound their wealth. This video comes out at a good time because it's time taxes to be filed, and this topic is always searched, like what's the difference between long-term and short-term. This will always be relevant to this part. And this video makes sense for me because I do want to expand this channel to be a one-stop shop for all of your financial needs. But at the same time, it's the guy reading some shit off of a script, and I experience the same issues that we all do in terms of finances, and I'm just sharing what I know. Hopefully, grow this channel. Be something smart, fellas.